All right, thank you for joining us this week for our third installment of a series on first-time home buyers virtual series. This week, we're going to touch on VA loans, USDA loans, FHA loans, and as usual, we're going to have our credit piece. My name is Shervin Joseph. I'm with FitzGerald Financial, a division of TowneBank Mortgage. Along with me is presenting the credit piece and the best credit person in the industry, Sean Higgins, from Senior Vice President with United One Resources. And he will do everything that you need to know and you're concerned about your FICO score or your credit score for that matter. Sean has been in the industry for 30 years. For those of you that have seen the previous series, the previous two installments, we've gone through the particulars, but I'll just refresh. Sean has been in the industry for about 30 years. I've been in the industry about 36. We've both been doing these seminars with each other for about 15 years. And we feel that it is a need of vital importance to educate through the literacy project all communities of color, women, black, white, brown, doesn't matter. We think everybody is entitled to the right and opportunity of home ownership, provided that you're qualified. So we're taking you through the process so you understand what it takes to qualify for a mortgage. So without further ado, Sean Higgins.
Thanks, Shervin. Good evening, everyone. Appreciate everybody taking the time to participate in our presentation tonight. My goal, as I always like to say, is to help someone out there that maybe needs some knowledge in the credit scoring and credit reporting process and help them become a homeowner. So I have a presentation, which we're going to put up on the screen, and get through some good information on credit scores. Couple of things right up front. There's my contact information. If anybody would like to reach out to me, I'd be glad to talk to you. One thing I always like to establish right up front is we're not a credit repair clinic. We're a credit reporting agency. Our company's been around since 1918. We work directly with lenders. So my point of entry in the transaction is generally working with a lender like Shervin and helping them improve the credit scores of their applicants. We have a really sharp tool, a simulator, which helps us understand where the score improvement is and what kind of money would be involved in it. So as I said, there's my information, and we're going to get right into it. So credit scoring. What is credit scoring? And it's a very, very important factor in the mortgage approval process. A credit score, by definition, measures the risk of default by the borrowers. So obviously, the higher the credit score, the less likely that person is going to default on their loan. Mortgage lending uses FICO Score version 8, and that is a score that's appended to the 3 credit files that most consumers have with TransUnion, Experian, and Equifax. I'd like to tell everybody a credit score is calculated based on the information in the file at that time that the credit report is pulled. So it's almost like a snapshot or a picture. Your credit report is accessed by the lender. A credit score is appended, and that's when we go to work. Sometimes credit scores need to be improved or can be improved. Other times people are perfectly fine. It's not a one-size-fits-all. One other thing that I'd like to also stress is credit fitness. It's a term you'll hear me use. Sometimes there's erroneous information in a credit report. There could be mixed files, junior, senior issues, those types of things. So we like to preach a little bit about credit fitness so people become aware of what's actually in their credit file and how it can be improved. Okay. So the FICO score ranges, as I said, it's FICO Score version 8. It's very important to know. The score ranges from 300 on the low side to 850. Anything above a 700 is considered to be an exceptional score. In our practice, we help lenders improve credit scores in the mid to mid 500s is probably a great point of entry where we'll help people actually gain credit points if they are available with a plan. Sometimes it can be done instantaneously, whatever it may be. Once again, one size does not fit all. This is a little bit of a new slide this week for me. I found some really neat information on FICO's website. So FICO is an acronym for Fair Isaac. That's the corporation that actually owns the credit score models. The scores are made up of a couple different components. And as you'll see, the biggest factor is always going to be the payment history. The balances or utilization, or as FICO likes to say, amounts owed, is the next biggest factor. The length of the credit history is the next important factor. New credit and credit mix have a lot to do with it. So there's right from FICO's website, the factors of what actually impacts the credit score. By and large, if you're making consistent payments and you're keeping your utilization or your amounts owed on your revolving debts below 20%, your credit score is going to be in pretty good shape. Okay. Okay. So one of the question that we get a lot in this business is how do inquiries impact my credit score? The short answer is not very much. Okay. So you have to understand what actually is an inquiry. An inquiry is when you actually give someone else permission to access your credit file. So there's two types of inquiries. There's a hard inquiry and there's a soft inquiry. The credit report will also list any of the inquiries that were made onto your credit report. The hard inquiry, that's used in connection with an application for credit. The credit report is accessed with the consumer's approval. A soft inquiry, which is a little bit less known, but there is some consumer knowledge out there about it. A soft inquiry is a credit inquiry that's made, perhaps if you have an existing account with a creditor, like a credit card company, they'll sometimes pull a soft inquiry on your credit report to see how your balances are performing and that type of stuff. It's also where consumers are pre-selected to fit into a certain criteria for a pre-approved offer of credit. The best example of a pre-approved offer of credit that I can give you is when you come home at night, you go to your mailbox and there's a pre-approved letter from a credit card company. That, before it got to you, was your credit file was accessed through a soft pull. There was a pre-approved offer of credit that was being extended by that credit grantor, and you fit the criteria. So that's how that comes into being. But you got to remember, though, hard inquiries, they're in connection with an application. A soft inquiry is generally without your knowledge. We'll talk about a little bit more about soft inquiries as we get a little bit later into the process. So the number one question on credit inquiries, how much do they impact my score? Okay. Here's the short answer. It's about 5 points after 30 days have gone. So if you make a mortgage application, you could pretty much expect 30 days to the day your score will go down by about 5 points. Okay. They will have a bigger impact if you have a small amount of accounts on your credit history, or if your credit history is even smaller, a shorter time period. I looked at a credit report for one of Shervin's counterparts earlier today, and the consumers had all of their credit was established in May of June of this year. It was not able to be scored because it was such a brand new credit history. So that's a good example of what a short credit history is. However, with our simulator tool, we were able to show the lender that probably by the end of November, there would be some pretty good scores available. Rate shopping. So if you're out shopping for a car and you try to do your shopping within 30 days, or on one of the bureaus, it's even as less as 14 days, it's going to be considered to be the same type of inquiry for the kind of business. It'll be considered one inquiry. So if you go to a car dealer and they start shopping your credit application to many lenders or many of the manufacturers, as long as that's happening within a 14 to 30 day period, it's going to have a little bit of an impact on your credit score. Now, what we do know is that if there's a large number of inquiries, that can mean greater risk. So in the example I gave before, there's a real reason for having your credit report accessed. You're shopping for a car, you're shopping for a home loan, whatever it may be. That's a pretty reasonable reason to have your credit report pulled. However, if you're constantly out there taking advantage of online applications for credit cards or something that you really don't need or shouldn't be doing, FICO says that if you have more than 6 inquiries on your credit report, there's a good chance that you're going to be bankruptcy. That's their statistic. It's 6 inquiries or more on a credit report, not for, like the examples I gave, shopping for a car or a home. it's 8 times more likely that you'll be bankrupt. And the reason they say that is because you're searching for a lifeline. That's what their statistics are telling them. So talking about improving your FICO scores, as I said, the ranges are from 300 to 850. There's 3 really easy ways to keep your scores high. It's pay your bills on time, keep your balances low. As I said, on the credit cards or other revolving products, 20% is the magic number. So if you have a $1,000 credit limit and you're keeping that balance paid on time, and you're keeping that balance at or below $200, you're really maximizing your credit score. You should only apply for and open new credit accounts as they are needed. Good credit management practices can help raise your FICO score are to, if you've got a little bit of a bump, you can come back from it. And we do establish plans with our with our lenders. And you can, it's not like it's a permanent thing that your FICO score is going to be always low. So you want to reestablish your credit history. The credit fitness that I spoke about a little bit earlier. Everybody in the United States is able to access their credit reports for free. Okay, you can do it weekly through 2023. The website is annualcreditreport.com. It's a great place to go to find out what's actually going on with your credit report. It's free. There will be some challenge questions along the way as to what address you lived at in a certain time, or what bank did you have a loan with. Those types of things are really just to make sure that the integrity of the person requesting the credit report is in fact them. So obviously, if you want to improve your credit score, there's obviously the converse is that there's going to be things that are going to impact your credit score to lower it. So any couple of reasons which really have the biggest impact on lowering your score. It's any current past due. So if you have a revolving account and you're late on it, I've seen that hit as much as 100 points against the FICO score. That could be a significant drag on your score. Derogatory trade lines, as I just discussed, high balances on unsecured debt, revolving debt, credit cards, however you want to describe it. If you're out near the max, you're really having a significant negative impact on your score. Any public record information that's out there, public record information is very, very tight on what gets reported on your credit report. It has to match a couple different ways. So we see less public record information entering it, but it's a negative impact when you have something out there, such as a bankruptcy or any type of pretty much bankruptcies or federal or state tax liens are, for the most part, what makes it on a credit report anymore. And quite honestly, if you have a lack of open active credit, it's going to have a little bit of a drag on your credit score as well. But enough about that. Let's talk about how we can improve credit scores. So if you have, the example I like to use is if you have a store card. We see this all the time. Someone may have like a JCPenney's, a TJ Maxx. I've seen it with Macy's. If you have one of those types of cards, you were late, and it was an honest mistake, they're very sympathetic. They will give you a one-time courtesy removal of that late. But it's got to be an anomaly. It can't be that you were late the last 6 months and you're asking for 1 month reproval. It just doesn't work that way. So the store cards specifically are willing to give that one-time courtesy removal. If you happen to have a collection account on your credit report, think about this. A collection account really does not belong on your credit report, but I do know that the collection agencies, they use it as a means to collect their money, obviously. But when you're negotiating with them to try to get that removed and offering a payment, that's your best time because they're salespeople too. So the time to actually ask for the removal is the time you're willing to pay. As I said before, get those balances below 20% on the credit limit. They'll have a very, very significant impact, positive impact on the credit score. We see a lot of student loan payments that are marked late, and the consumers will come to us through the loan officers and say, hey, this is in deferment. And usually 9 out of 10 times, the reason that that's being reported late is because the paperwork issues were with the servicer. So we advise people to contact that servicer, supply proof of student status, and request the removal of the late. And finally, we also like to advise people, if you have an installment loan, say a car loan with a 48-month term or something like that, paying off that installment loan in advance has very, very little impact on the credit score. you should probably save those funds for other more pressing items that will improve your credit score. So I see we have a question from David. We have noticed that if you put 2,000 to 5,000 on a credit card, it'll drop your score by 50 points. Then we're going to have to talk a little bit more about that. Once again, we have noticed that if you put 2,000 to 5,000 on a credit card, I know some Amex accounts have a monthly due status, which means that your balance is actually due every month. And the bad part about that is it'll have a credit limit of $2,000 to $5,000, whatever the example you give. Let's just stick with 5,000. So a $5,000 balance on a $5,000 limit will have a negative impact on your credit score. So we're using Amex as an example because that's how the question was pointed to me. And I think it has a lot to do with the type of account. You may want to reconsider the type of account that you have with Amex and ask them if you can have an account that could be paid off over time as opposed to the monthly due. That's what we've seen cause those score drops that your question is asking. So let's talk about Credit Karma and let's talk about Credit Fitness. So Credit Karma is, they have over 100 million active users right now. Okay. Credit Karma is a great credit fitness tool. However, as you've heard me say in the past, Credit Karma is not the score. They do not use the score that we use in mortgage. As I said, we use FICO Score version 8 in mortgage lending. Credit Karma uses a score called the Vantage score, which is the word advantage without the AD in front of it, Vantage. So it's not used in the mortgage industry, whereas FICO is. They do have the same score ranges. FICO will score on all three repositories, which is another word for the credit bureaus. Credit Karma will only score on Equifax and TransUnion. That's all they're signed up with. There are your score factors for FICO, and Credit Karma's Vantage score is a little bit less scientific. They don't really disclose any percentages or any of their algorithms. They use words like highly influential, moderately influential, and less influential. So there are differences. The most important thing to know about the difference between these two scores is there's going to be a 30-point difference. We talk to loan officers all the time. And when they have an applicant come in and say, my Credit Karma score is a 780 and you're showing a 750, why? Well, there's your reason why. They're two different scores done by two totally different companies. In the case of Credit Karma, it's only seeing activity on two credit bureaus, whereas FICO is showing all three. And FICO is very, very specific in how they do the calculation. Sometimes rent and utility bills are part of the mortgage process. And quite honestly, FICO does not consider that in their score model. However, Credit Karma does. There's differences. The thing to remember, it's a great fitness tool. However, it's about a 30-point difference. Experian Boost, that's out in the mainstream right now as well. Experian Boost does not improve your credit score for mortgages. The reporting is to Experian only. Experian Boost is in the general public. It's on TV quite a bit as far as advertising. And what it's best for is helping people with a very thin credit file, which means little or no credit report. It helps them build. It helps them go out and maybe get a cell phone or a utility connection, but it's not going to improve the credit score for the mortgage. It's a little bit misleading as far as that goes. Rental information. Fannie Mae came out about a little bit over a year ago and said that they'll consider rental information in the mortgage lending process, which means basically they're going to build it into their black box for their decision. It's not going to be anything that's going to have an impact on the credit score, however. Rental information is very, very important in the mortgage process, which Shervin has said and will continue to say, but it's not part of the credit score. Once again, this made its way into the mainstream and created some confusion, but by and large, everybody understands its purpose and understands it does not have an impact on the credit score. Medical collections, that's something very, very important right now. As I said before, medical collections are really put on credit reports as a means to extract payment. What we have seen is a lot of paid medical collections prior to that July 1st date. Zero balance medical collections were still on the credit report. And that was causing people anywhere between 30 and 100 points to their credit score. So now they're off. It's great that they're off. It's a great means to help someone improve their credit score who was probably being, unfortunately, impacted in their credit score. This past July, they also changed the waiting period to start reporting collections on the credit report. It moved from 6 months to a year. And starting in the beginning of next year, if a medical collection is balance is below $500, it's not going to make its way on the credit report. It's going to have a very, very significant impact on scores. As I said, 30 to 100 points, which is very, very meaningful for people in the competitive market that we're in for home ownership. I usually end it with this website. There's all the contact information for the 3 credit bureaus. They're great people. They will talk to you about your credit file. They have consumer assistance people that do that. Their websites are there as well. Annual credit report, as I discussed, that's a great way to get a good feel for what's going on with your credit report. And then the best for last, opt-out pre-screen. As you heard me say before, the pre-approved offers that come in the mail, they can be troublesome. If the wrong people get their hands on your mail, you could have the potential for some identity theft type of issues. We've seen people come to us and say, hey, this is on my credit report. I never had this relationship. And it turns out that they're telling the truth and they were a victim of identity theft. So if you go to opt-out pre-screen, it'll stop the pre-approved offers from coming to your house. And we advise consumers, highly recommend that they take a look at that. That is all I have for today. If anybody has any questions, you could put it in the chat box and turn it over to Shervin.
All right, Sean, as usual, just awesome presentation and great information out there for you folks. That was a great question by the gentleman that had the question about American Express. I'm just curious, was the question posed as if he put down, if he paid $2,000 or $3,000 a month in the movement because it was monthly? Because there's Sign and Travel American Express too that has a balance. It could be a balance of $5,000. You put down $3,000, and you might get a little movement on your score. So curious, but that's interesting because I think that probably your answer opened up some eyes for those that have that pay, the one-time pay of Amex on a monthly basis. Where the payment is due pretty much in full every month, and that will move the numbers.
I see David has a second question, Shervin.
Okay, I don't see that, so
yeah, I'm gonna take a stab at that. So he said,
sure.
How do we as parents help our children prepare for credit excellence? As a parent, I would say teach them good lessons on paying debts on time and not getting into things that you shouldn't. That type of stuff. But we do see an opportunity for younger children to go on parents' accounts as an authorized user. I did that with my 4 children. And essentially what you do is you give them the benefit of a revolving account that you may have. They'll get the credit history, provided it's good, on their credit report. And an authorized user account is one of the greatest tools that are out there. As an authorized user, you get the benefit of the credit history and you're not responsible for the debt. So that's a tool to look at. We could always have a sidebar on that as well.
Yeah, I think that, well, that's a great answer too. I think that you hit it right on the head. The authorized user mechanism is something that we used when we raised our kids as well. And they're adults and they have excellent credit. But I think it starts with not only the authorized user and helping them manage it, but you, as Sean said, you have to assist them in understanding what is worthy of buying and good credit management. In other words, it's not constantly abusing the card and managing it on a monthly basis and understanding when payments are due and how to eliminate the debt so it doesn't get out of control. Because we all know from high school to college students, if you're not assisting them and showing them a great blueprint for how to manage something, it could get out of hand. So it's very critical that you show them the blueprint and, trust but verify type situation and how to manage that. But that's what I would do. I think too many instances we see folks give kids a card and they take it and run with it. And they're not looking until surprise that statement comes in the mail or they hear that the account is gone south. So very important that you pay attention if you want to use that route as an example. The series is what Sean just presented and what we've been doing here for the last 2 weeks, and this is our third installment, is important for many reasons. If people of color is to close the wealth gap and the home ownership gap, which is currently at 75% for white Americans and 44% for Black Americans, according to the U.S. Census Bureau, it is imperative that we receive an accurate education on the value of home ownership and understand the process of how to become a homeowner. So we hope that that's what we've been doing with Sean's education and credit and what I've been presenting to you on the home ownership products. Last week we covered grant programs. This week we're going to cover government programs, FHA loans, VA loans, and USDA loans. So if I could get started here, and if that would be great. So I'm going to start this week, and we're just going to cover the types of mortgages that's available to you. Now, the most lenient and the most flexible of mortgages is the FHA loan. It is a government loan. Down payment requirement is 3.5% down. You could use gift money for a down payment. And what does it mean, gift money? Well, you could get a gift and it has to be documented. There's a gift letter that we would pass on to you to be completed by yourself and the donor. And the donor could only be mother, father, sister, brother, okay? Not a friend or anything like that. It has to be a relative. And again, mother, father, sister, brother, it has to be documented. We will ask, just like any lender, will ask for support documentation, a bank statement of the donor, and showing that the funds were transferred from one account to the other. You cannot use cash. Cash will pretty much kill a deal. So you don't want to just have somebody give you $2,000 or $5,000 and there's no paper trail. Everything in the mortgage process requires a paper trail. It's a less strict debt to income ratio. So there's flexibility there with your debt to income ratio. And what does that mean? Your debt to income ratio is what your total income is and the debts you pay. So you take your debts divided by your total income and you'll get your debt to income ratio. Usually qualifying is about 41% and the flexibility goes up, and we have great flexibility with that. But again, your profile, credit, assets, employment, how long you've been on the job and so forth plays a role into this as well. And when I say flexible credit qualifications, that's where the flexibility comes in based on your profile and so forth. And can be used towards home improvement. So there's also an FHA loan. There's a home improvement component to the FHA loan, and it's called a 203K loan. And I would suggest that first-time home buyers not go after a 203K loan because it should be for someone that's accustomed to managing a mortgage. That's my opinion. That's not my bank's opinion. Keep in mind, I work for FitzGerald Financial Group, a division of TowneBank Mortgage. And just in January, Forbes Bank Forbes magazine tagged us as the number ninth lender out of about 5,000 lenders in this country. So as the number 9 performing lender. So that's pretty good a reference and a pretty good endorsement. So we love that because we've worked hard for it. But that just gives you an idea of the quality of people that we have here at FitzGerald Financial and TowneBank Mortgage. FHA Loans, I have to say, has the flexibility that you could work around. And when we say flexibility with flexible credit qualifications, you know, you might have some lates in the past. So it's not something that you could not explain. So it's very important that you understand that that is probably the best and most flexible loan for someone just tight on money and tight on credit score. Okay, very important that we understand that. Also, FHA and VA loans are probably best priced loans. So when you look at it, interest rates in this particular market that we're in, the interest rate is going to be about 0.75% to 1% on any given day, better than our conventional counterparts, conventional Fannie Mae and Freddie Mac. So that's just a note for you when you're qualifying for a mortgage. The next loan is a VA loan. The VA loan is uniquely allows you active duty, reservists, and veterans. Now, I'm a former Marine, so I know everything there is about a VA loan. One of the best loans if you qualify for the VA loan, if you served your country in any capacity in the military, then it's excellent. And you should never just sit on a VA loan and say, yeah, I'm going to do this one instead. It offers you no money down opportunity. There's no monthly mortgage insurance. And the veterans and some surviving spouses have the opportunity to purchase. So it's really a great, great instrument to purchase a home. The no money down requirement, of course, you'll present your DD-214 and we could request your certificate of eligibility that says that you're eligible. So we could get that once we have your DD-214 and we could enter the information for you. There's flexible credit requirements similar to FHA, so it gives you a little bit more flexibility than a conventional Fannie Mae or Freddie Mac loan will give you. There are no prepayment penalties on our loans, particularly on a government loan and a VA loan, there's none. There's a lifetime benefit that can be reused. In other words, if you sell your VA loan down the road, 5 years in, and you decide you want a bigger house, you sell that house and you want to buy another house with your VA and eligibility, you can do so. And so it's a great opportunity. Here's a really good piece of advice. With conventional, the seller could only pay up to 3% with 5% down, and with 10% down or more, they could pay up to 6% seller contribution. With VA, you could pay 4%, but you could pretty much have the contract read that the seller agrees to pay all prepaids and closing costs, and the buyer, no money down, seller paying all prepaid and closing costs, could actually walk into settlement, sign their docs, and not have to come out of pocket with any monies. It's a pretty incredible instrument.
Hey, Shervin, we actually have 5 questions.
Oh, okay. Well,
you're on such a roll. I'll facilitate for you. You ready?
Yes, please. Thank you, sir.
First one is, what is a revolving account?
I'm sorry?
What is a revolving account?
A revolving account is anything with regards to a credit card or a credit line that's revolving, adjustable, flexibility. Is that what we're talking about in a revolving account?
Yes, sir. You got it.
So I think that's those are the revolving accounts. Revolving accounts, going back to credit, those are the ones that Sean had noted that you could pay down to increase your score. Installment debt does not generate an increase in your score.
Next question is, how do you switch from a monthly card balance due to a longer term balance type card?
Well, I'm not sure on how you would do that. That's something you will have to discuss with your creditor on how you would do that, because particularly I think we were talking about American Express. And if you're looking at that situation, you need to contact them and ask them because they control the guidelines there. We're mortgage. Yeah.
Well done. Next question is, what do African Americans need to do to close the wealth gap?
Well, at first, it starts with home ownership. The quickest way to close the wealth gap is to start by buying homes. The quickest way to wealth, as we all know, is purchasing homes. So getting pre-qualified or setting yourself up with programs like what Sean just presented with credit and putting you in a position to buy, and what we're talking about here with different types of loans, and understanding pre-approval sets you up to see how much money you need, what you need to improve on with your credit score, what you qualify for as far as a monthly payment. All of that sets you up so you can go ahead and purchase a home. But purchasing a home is the number one access to creating wealth. That's how you start.
Absolutely. Couldn't agree with you more. Next question. Can you only use an FHA loan on your first home purchase?
No, you could use a conventional loan. You could use an FHA. And the great thing is that that option is up to you. A conventional loan obviously is 5% down, and you have to have excellent credit. There are opportunities for 3% down. However, as I said before, with FHA, the rate is going to be, in this market particularly, FHA rates are going to be better than conventional rates. Now, it's all predicated too on what kind of contract the seller's willing to take. A lot of sellers will take a conventional loan because they figure that they'll have more flexibility with the appraiser. I don't happen to hold that opinion, because I think that the appraisers are going to find if there's something that's undesirable about the property, they're going to put it in writing. So the decision is up to you on whether you want to go FHA or conventional, but you do have an option.
Thank you. Next question is, when does PMI come into play on your loan?
Well, PMI is a conventional, it's mortgage insurance. It protects the lender against anything happening to the property. And anytime you're paying less than 20% down on a conventional loan, you have to pay private mortgage insurance. Okay, if you pay more than 20% down, you eliminate mortgage insurance. However, on an FHA loan, it's called MIP, mortgage insurance protection, and it's mandatory throughout the life of the loan. So in a sense, with FHA, you would have to refinance that loan to get rid of the MI component, the MIP component. And conventional, and I said 20%. It's usually when your loan to value goes to 78%, it eliminates MI. But that's something you could do with your servicer, whoever your loan servicer is. You could discuss that with them. If you feel that your loan, you've been in a house a number of years and you've acquired the appropriate equity, then you could approach your servicer to see how you get out of the MI.
Okay, thank you. Next question. My nephew is a retired Marine. Can he apply for a VA loan? If so, where?
He could give me a call. Shameless plug, but or any lender that is VA. Now we're connected with VA. It's called VA Automatic. Not all lenders are direct endorsers with VA. Yes, he's a Marine. He's served. He should be, as long as he qualifies with credit and has the assets to purchase a home. Absolutely, we will qualify him. And the good thing is that we close loans in less than 30 days, usually in about 3 weeks. So we could put him in a home provided that he qualifies. But anyone that is served, regardless of the branch, we won't hold it against you for the other branches. I'm only kidding. But absolutely, we were more than happy to take care of your nephew.
Last one, Shervin. Will current interest rates stop me from buying a home?
No, that my opinion. I think that anytime you have an opportunity of purchasing a home, you take that opportunity. When you sit on the sidelines and you don't engage, you lose a lot of equity and an opportunity to equity that you could use to buy another property. Keep in mind, just a fun fact here. Pre-COVID, well before COVID, before the rates were 3% and 4%, and we got spoiled, rates were at 5%, 5.5%. Just 20 years ago, rates were, pretty high. 30 years ago, when I came into this business, Sean came into the business, it was in double digits. Now, if you're asking me 14%, 13%, yeah, but people found a way to not only buy homes, they got very creative, and there was no drama with getting homes. It's always, you still have to save, you still have to have decent credit and so forth. But now we're only talking about 6.5 to 7% rate. And the great thing is you could get a home and you could either do a 2-1 buy down. That's an option that's available to you. And that's a whole nother presentation. There are adjustable rate mortgages. They're available. I'm not a fan when you could still have, and I consider a 6.5 to 7% a decent rate, because guess what? In another 2 years, the rates will probably come down a little bit and you could refinance right out of where you are. So I think that anytime you have an opportunity and you qualify for a mortgage, you should take that opportunity and just jump on the ability to have home ownership. Again, that's how you build wealth, and that's how you allow yourself to accrue equity and build for your future, as opposed to just waiting and waiting. You don't know what you're waiting on. You might wait yourself out of the market.
One last question, Shervin.
Sure.
What's the best loan type for anyone under 700 credit score?
Well, it depends on how far under 700 credit score. If you're talking about between 620 and 700, you have a variety. You could do FHA and VA, depending on if you qualify, and you could go from 620, 680, and if you're looking at conventional and you have the money down where you could eliminate mortgage insurance, you certainly could go with a conventional loan in that respect. But we do 620 and better on FICO Score, so you will be in good shape to choose either one of those. But again, it depends on the particulars, what your loan amount is, how much money you're putting down, and what the rest of your situation is, how much assets you have for closing. So, there's other particulars that we need to know from a pre-approval situation. But yeah, it sounds like we have a lot of folks there that are in position, but you just have to take the leap, and you shouldn't be afraid to take the leap, because right now, here's the other option. If you're not buying a home where you're accumulating wealth, if you're setting yourself up with equity, you're paying somebody else's mortgage. and they're
Right.
accumulating wealth and they're accumulating equity. Whether you're renting in a house or renting in an apartment, you're paying somebody else's mortgage and it's not yours.
Thanks, Sheriff. And spot on as always. That seems to be all the questions. I'll be sure to let you know if there are
Oh
any
yeah,
more.
let me know if there's more. Absolutely. So yes, with VA, it's a lifetime benefit, and if you sold the house, as I said previously, you get to use the VA entitlement again. So there's only two true 100% loan programs, regardless of what anybody wants to, sell you, a bill of goods that they could give you 100%. You're not paying any extra for it. It's a VA loan and a USDA loan. And a USDA loan is one of the great instruments in buying a home, depending on where you want to live. The USDA guaranteed rural housing it helps borrowers achieve the American dream with zero down payment and minimal investment. It's a 101% financing for qualified moderate income families looking to purchase single family homes. It's ideal for borrowers with little or no cash. No down payment required. Loan limits are based on areas eligibility, low upfront fee, and low monthly mortgage insurance to be reduced based on principal. So the flexibility on the debt to income ratio is similar to FHA's, reasonable credit requirements. Now, let me just add the caveat here that a USDA loan is considered a rural home. Now, if you're around the beltway of Maryland, DC, and Virginia, and for instance, you're in Maryland and you're looking at Brandywine, Waldorf, I'm just giving you areas that might have USDA capability. Malton and Upper Marlboro, Dunkirk, places in Virginia and Woodbridge, Manassas, etc. Is critical that people understand that you have to have the house has to be approved, not necessarily the subdivision or the county or the city. So you have to go onto the USDA website to see if the property is eligible. Certainly, once you get a realtor, and the realtor, if you called me with the property address, and I would only look it up after I know you're pre-qualified, because it doesn't make sense looking at a property if you're not pre-qualified. You have to know what you're capable of purchasing. So once we look up the property would either tell us eligible, not eligible. Eligible means that the property is eligible to be purchased as a USDA no money down loan. Non-eligible means you could purchase the property, but you'll have to purchase it as a FHA or conventional. So you have those opportunities there. And USDA, I got to tell you, is one of the best kept secrets. And I'm not sure how it is, because I do a bunch of USDAs, but anytime you talk to folks about USDA, they seem totally surprised. And keep in mind that you might drive a little further to work and so forth, but if you have great credit and you're trying to save money and you don't mind living a little further out from where you work, and it might be an extra 10 minutes or 15 minutes, but it makes sense, and you get more bang for your buck sometimes when you go out on in the suburbs or in the rural area. And if you get a house that's USDA component, then that's just a great opportunity.
Shervin, we have a question.
Sure.
How much house can you get with a USDA loan?
Well, anytime it's how much house question depends on what you're qualified for and if you're qualified. I don't have it in front of me. However, I do know that USDA is blocked at income requirements for husband and wife combined and for one person combined. So we would have to have that information available once we get, we start speaking with you and assess where you are and let you know what the plateau is for income. And as far as sales price, I do know you could get up into the fours, and I believe you could go as high as five. But again, we would have to see where you're located and what the county allows for, and so forth. So yes, and I'm sure that you'll be able to buy a house that you didn't think you were able to buy and no money down. In other words, these aren't 300,000 and below. You could buy any house up to about 400,000 or 500,000. But again, we would have to check your requirements, make sure that you're qualified and so forth.
Thank you, Shervin.
Sure. So with that said, on USDA, that's about all I have for those options and those types of loans. However, in every segment, I always leave you with this: the home buying don'ts. These are don'ts. What I always like to say, we go through this, all loan officers, processors, compliance folks. We tell folks, please do not do this, because we've seen it over and over and over, and we want you to own a home. We don't want you to lose the opportunity not to own a home. So these are the home buying don'ts. Number one, do not change jobs, become self-employed, or quit your job. In other words, I know recently someone contacted me and they wanted to buy 800,000, and they said their wife was a doctor but just went self-employed 2 months ago. Can't do it. We need 2 years tax returns for that. So don't change jobs. She was salaried, would have qualified easily. So number one, do not change jobs, become self-employed, or quit your job. Number two, do not buy a car, truck, or van while you're in the process. That changes dramatically your qualifications. You might still qualify, but a note for about $500, $600, $700, $800, you know that changes your debt to income ratio. Number three, do not use charge cards excessively or let your accounts fall behind. I'm going to say this repeatedly. Do not assume that once we pull a credit, your credit is not going to be looked at again before closing. Okay? A lot of companies do a soft pull to make sure everything is okay with your credit before closing. Don't put yourself in that situation. You never know what will happen. Number four, do not spend money you have set aside for closing. If you have a trip you want to go on, let's wait until after you close and you get your keys. Don't go on a trip, 4-day weekend to Cabo, and the next thing you know, you're enjoying life so much, you're spending your money for closing. So keep that in mind. Do not buy furniture. Furniture could wait until after you have acquired your home. Number seven, do not originate any inquiries on your credit card. You heard the credit score drop. While it's not a colossal amount, it does happen. And any inquiries that are on your credit report that they might pull, they meaning compliance or underwriting, might pull a software pull on your loan, has to be explained and has to be justified. Do not make large deposits without first checking with your loan officer. Every large deposit has to be paper trailed and explain where the money came from. Very important. Please do not make large deposits without first checking with your loan officer. Number 9, do not change bank accounts or move money between accounts. Absolutely critical. Okay? We just keep your money where it is. And if you have a question, give me a call. I'll be more than happy to counsel you and give you advice with that in regard to where things are. But there's no need to move money because we're more than likely going to have bank statements on all accounts. So keep everything simple. Number 10, do not, repeat, do not co-sign a loan for anyone. That dramatically will probably change the dynamics of if you qualify or not, because that's a huge hurdle if you're co-signing for a car or something like that. All right. And I think that's all I have. So if you have any questions, please let me know. We've had some great questions tonight. Sean, I appreciate you co-piloting and getting those questions in so we could provide the answers. But if you have any questions whatsoever, please feel free to.
Sure, we have one more question.
Oh, yeah. Let's do it.
You ready? Does paying off loans help me during my house loan process?
It can, but again, we have to know your situation. So for me to just generally say, yeah, paying off loans will generally help you because it'll lower your debt. Okay. But I think what we want to do is we want to assess where you are and if it's even needed, so we could see what's needed to be paid off. And if you could pay off the debt and still have your funds to close, then sure, that's up to you. That's a decision you have to make. But yes, it won't hurt you. In other words, it would only help. But make sure that you have your money for down payment and closing costs as well, and that you're not using those funds to pay off debt and then you have no money to close on the mortgage.
Thank you. Well put. And if it's an installment loan, it's probably not going to help your credit score.
Yes, please. Thank you. That's huge. A lot of people just don't realize it's not every debt you pay off that will trigger your score to increase. It's got to be revolving debt, credit cards, and credit cards.
It looks like that's the last question. Lots of good questions, though, tonight.
Yeah, very good question. So people are well engaged, and it sounds like people are ready. So my contact information, Shervin Joseph, 571-278-8351. It's my cell. My email, Shervin.Joseph, that's SHIRVAN .JOSEPH at FitzGeraldFinancial.net. And Sean's contact information is
570-706-2830. And my email address is shiggins. That's my first name, first letter of my first name, I should say, shiggins at unitedone.com. And the one is spelled out ONE.
All right. Well, thank you guys for attending. We appreciate you attending. Don't forget, next Tuesday, we have our last installment for this quarter with regards to just major Q&A and a kind of recap of everything we've done for the last 3 installments. So we're going to wrap it up, probably going back to number 1, but answering your questions with everything. So if you know anyone that wants to attend, it'll be the same time next week at 7. And I can guarantee you there's going to be more information that we didn't cover on tonight. So it's going to be kind of a recap of all of the 3 previous shows. All right. Well, thanks again for attending. Thanks, Sean, for a great
Thank you, Sean. Thanks for having me.
presentation.